Hello, my name is Dr. Leland and I will be your instructor for our class. I'm very excited about this term and what we're going to be accomplishing. We will normally be meeting on Sundays, but I had some technical issues, so we weren't able to do that. So instead, I'm going to go over the material with you for week 1, and we're going to kind of go over what the expectations are for the class. I will be sharing my slides with you for week 1, and we're going to be looking at chapter 1. So make sure if you have your syllabus to review what we'll be looking at for week 1. There is a discussion question on value chain, and we will be looking at the value chain and the components of the value chain in terms of the necessity and what all is included. So this is a course in managerial accounting. I've had the pleasure of working in the field of managerial accounting. I worked for Ray-Ban, which is a sunglass company, for several years. I also worked at an aviation company, 2 different ones actually, as a business unit controller, and I worked in the finance department. And I also worked in a manufacturing company that what we did is we created dehumidification systems. So it was a very exciting time for me to really get my hands involved in the costing process when I worked in manufacturing. The main goal of this course, if you had a chance to look at the syllabus, we're going to look at so many characteristics in terms of managerial accounting, which, as you can see from the readings and some of your discussion posts I've already looked at, managerial accounting is a lot different from financial accounting, right? Financial accounting is more based on the reporting aspect and following GAAP, which is a generally accepted accounting principles, which some of you have already alluded to. So we're going to be really looking at the internal parts of the organization and the internal decision making that goes on, because managerial accounting, the focus is on decision making and reporting. Reports are very important for the costing process and getting the information to managers that need it the most. So we're going to look at qualitative characteristics, the quality portion of the field, and we're going to be looking at so many different factors that go beyond just your regular financial accounting. Now, I see that some of you have already posted your introductions into the course, and I thank you for that. It's been such a pleasure meeting everyone so far. I posted my bio in the course, and you can read a little bit about me. My background is in finance and taxation, as well as accounting. I'm well versed in all the areas, and I really enjoy working with numbers. In addition to that, I am a mom of 4 children, and I have many interests. I like to go running and reading, and I like basketball, and I like to swim. I live in Texas, which is in a very hot part of the US. I think yesterday was 95 degrees and it's already September, which it should be much cooler. In addition to that, we have pets, and we have pet bunnies that my children and I enjoy spending time with. But my true passion in life has always been teaching. I've been teaching since 2004, both online and on ground, and that's really where my passion rests, is meeting people and sharing my knowledge with others. So I'm very excited to get started. For week 1, The main goal, as you can see from the syllabus, is reading chapter 1, discussion, and then of course the live session. Week 2, we will not have a live session. We will have another one in week 3. So if you have any questions, feel free to email me. I provided my contact information into the discussion area. I wanted to take a step back real quick before we go into the slides and kind of just let you know that in managerial accounting, in the field of managerial accounting, we do have certification. It's called a CMA. It's kind of similar to a CPA, which is Certified Public Accountant for financial accounting. But for managerial accounting, we have something called a CMA. And I'm going to try to share my screen for a minute, if I can, so that you can kind of see what I'm looking at. Hold on one second. There we go. Let me try to share this real quick. So as you can see here, we have the CMA certification, and what it is it's a certified managerial accountant. And it's a kind of a designation in the field for those who are interested more on the managerial accounting side of things. So you can go to the website. I provided it here. I'll also make sure to copy and paste it into the chat room area. But this is what, if you want to go to the site, it talks a little bit about the exam, the CMA. It talks about the field. It's an examination that you have to take similar to a CPA exam. And also it talks about how to get started taking the exam. There's also a, if as a student you can get a student membership, but there is a professional membership. I'm a member, but it's a nice designation to have. It sets you apart in the field. But if you also want to just kind of peruse this area, you can see it has 2 parts. And this is really what we're going to be looking at when we study this field. So you might just want to peruse it, and talks about the value of the CMA. Very important information. So let me go back to the class, and I'm going to post it in the chat area for you. This is the website if you want to check it out later, okay? So now let's go ahead. Normally we'd be in a live session and I would take some questions, but let's go ahead and look at the slides, because I want to be able to discuss them and kind of provide some insight into the material. So let's look at the slides. I'm going to share my screen so that we can get a better understanding. So we talked about this a little bit already, the differences between managerial and financial accounting. What I like about this visual is that it breaks it down into the 2 parts: financial accounting and managerial accounting. Managerial accounting, that we said earlier, focus on internal processes and decision making. For instance, when I worked at Ray-Ban early on, my goal when I first got there was to do inventory reporting and scrap reporting. We would look at the sunglasses that we were making in manufacturing, and my job every week was to run through the production reports and to look at the scrap counts and evaluate variances to determine, was the scrap count high this week? Was it low? Was it a particular product that was causing this scrap to be higher than normal? So that was kind of what my main job was. Here you can see in this visual, we have a breakdown. of how they differ. So financial accounting, we focus more on the financial statements. Because I'm sharing my screen, I can't draw on here, but managerial accounting, we're looking at internal reporting, we're looking at production, we're looking at labor, we're looking at budgets. These are reports that the public would not see, they're not privy to. Only those who need them, the management team, for example, if you're the manager of the, I'm going to go back to my Ray-Ban example. If you're the manager of production on your job on the floor is the department of making the frames, and you want to control overtime because overtime has gotten out of control, then you would want to run reports on labor times and variances for labor. Why has labor spiked so much? Why is there excessive overtime being worked? Are they not able to get their job done in a normal amount of time? And if so, why? Is it because they're having difficulty making the product? Is it because the material that they're using is faulty or defective? So it really helps you troubleshoot and try to, we have a term where we say kind of put out the fires before they start, right? Because you want to solve the problem before it gets out of hand. So that's kind of, to me, and I find it challenging and I find it exciting to work in the field where you're constantly troubleshooting and solving problems. So as you can see on this table, when we look at the managerial accounting, the users are management. It's not the public. It's not external users, right? And the nature would be both objective and subjective. Subjective because we're trying to maybe look at our own department or our own faults to troubleshoot. Now, guidelines for preparation. Here you can see this type of accounting is for management only, and there are no GAAP standards have to be followed for this type of reporting. If we were looking at financial reporting, you have to follow the guidelines of GAAP. The timeliness, well, we know that in financial accounting, you have to follow monthly reporting guidelines. You have to file quarterly reports and annual reports. But with managerial accounting, there is no due date for reporting, right? It's because it's based on your needs and your decision making. The focus of the reporting, well, for financial reporting, we're looking at the company as a whole, right? But for managerial accounting, we're looking at maybe a department or a segment or maybe just a particular part or production line that we're curious to see what's going on. I know especially when you are creating new products or you've just released new products that there will be glitches initially, learning curves with labor. Labor may not be used to making that particular product, so they're going to have a lot of maybe scrap their first couple of weeks as they learn to become more efficient at making that product. So the two sides of this accounting are vastly different. Now, continuing on with this look at the differences. Let's see here. Here we see financial accounting. We know that it's reported on a monthly, quarterly, and yearly basis. That's according to GAAP guidelines and rules. And we know from in financial accounting, you have standard reports that have to be reported. You have the income statement, statement of stockholders' equity, balance sheet, and statement of cash flows. And these are mainly published and produced for external users. Public companies, you know, they need to follow the SEC guidelines. They need to, if they're selling stock on the markets, they have to make sure all these filings are reported with the SEC. They have to be available to the public. It's very important for full disclosure to make sure that that is available. And the focus here is on the external users. These reports are significant for all stakeholders. Stakeholders include shareholders, creditors, the public, government agencies, also even just the employees. It may be a company with a employee stock plan, and the employees have a vested interest in how well the company is doing as well. So it's not just necessarily, the public at large. Now, as we shift focus here to the managerial side, the reporting here is done for management's needs and making sure that they have the information that they need. And these reports can be created on a whim. I know that when I worked in aviation, we had this one company that I worked at. We were working on a corporate jet, and there was a lot of R&D, research and development expenses, and we had to constantly be reworking parts. It's basically when you have a part and the part it's faulty or something wrong with it, we would rework it in engineering. And when we reworked it, we would put it back on the plane to make sure it was functioning. So there was a lot of rework involved, and we did a lot of reporting to cost analysis to determine whether it was worth reworking the part or whether it was better to just buy a new one, outsource it. So it's really amazing how the reporting can vary based on your needs. And so with managerial accounting, we are looking at not only what the problem is today, but also future. How will we use this reporting, this knowledge for the future? And so it's all about developing business strategies as well. Because remember, managerial accounting also puts a lot of emphasis on budgeting, and they need this information for budgeting purposes as well. And I'm not sure if we get into it in this lesson, but managerial accounting uses Excel as a main tool, but also the computer system that will be used is dependent upon the industry many times. There's so many enterprise resource planning systems that are used. Aviation needs to have a certain type of system. If you're making, and maybe if you're in the food industry, you're going to have more of a process costing system. So it's really dependent and contingent on the industry. Here, I'm not going to read these, but we'll go through them and kind of as we talk through the different factors. But it's interesting to note that managerial accounting does not have to follow GAAP. It does need to follow standards in terms of making sure the information is accurate. But in terms of following GAAP guidelines and you need to use this methodology, it's not strict in that sense, okay? And like we mentioned earlier, you don't have to follow the strict guidelines of monthly, quarterly, yearly filings and reporting. These are reports for managerial accounting will be required at certain times for certain needs. It's really just based on what the needs are of the organization and how can we best fit those needs. And managerial accounting, also we need to point out, is it's not just based on, what is the stock price? How are we going to do in the fourth quarter? It's about the product. It's about the project. It's about segments of the company in relation to the company as a whole. So it's really looks at troubleshooting, solving problems, finding variances, and figuring out how we can overcome major variances. So when we look at managerial accounting, we need to look at the large companies in terms of vertical and horizontal. And you may be wondering, well, what does that mean? What does vertical and horizontal mean in relation to the company? Because so a vertical organization, when we think of vertical, we think up and down, right? So these are referred to as business units because they're structured as several separate businesses within a parent. And these verticals develop products sold directly to the customer. A horizontal is are departments within the company that are not responsible for developing the products, but they provide services to the various verticals and horizontals. So that's just to give you a different way to describe organizations and how we look at them in terms of reporting, costing, controlling, and those functions. Speaking of controlling, let's look at this visual. Here you can see we have the controller, and the controller is the head of the financials of the organization, right? When I worked at Fairchild Dornier, I was a business unit controller. When I worked at, it's called Munters, I was an assistant controller. And in that role, I got to be not only a leader within the business, but I was a supervisor and I helped spearhead the financial reporting aspect. Now, the controller is in charge of or goes directly influences the chief financial officer, which is the CFO, and the manager of the accounting function of a vertical, and also rank within the accounting and the finance function. And maybe many of you aspire to be a controller. I think I read that in a couple of the bios. And so this course is going to fully prepare you for what is involved in that role. Let's look at the management process. What do we have here? Well, and I wish I could use my pointer, but we'll kind of talk it through. As you can see, the management process influences all of these other factors. We have the planning, we have the directing, controlling, improving, and decision making. These are all management functions within the organization. So managers have a really important job, and we need to, as management accountants, give these managers the information that they need to ensure that our organization is successful. That is our main goal, is to make sure that they have the tools that they need to be successful. Now, what about the operational side? Operations, these are the folks that are making things happen, right? These are the folks that are making a widget turn into an airplane or a widget turn into a car, okay? And maybe some of you have some operational experience. It'd be great to learn more about your experience in terms of operations. I know a lot of people who work in the auto industry and the assembly lines, and so I always try to get a lot of examples to use from them and their experience in working with automobiles and making them and creating them. But operations, here we can see that it all starts in the middle with decision making, and that decision making is important because decision making is something that has to be done within operations. Of course, it's the heart and soul of it, but also it influences these other factors that you see: the directing, improving, planning, and controlling. And I think it's important to point out that in the planning bubble right here, that it mentions strategic and operational. Strategic being long-term, and operational being short-term, your tactical daily planning, strategic being more of your strategic long-term vision, long-term forecasting, that kind of thinking process and planning. So breaking it down, planning is all about developing a company's goals and translating them into action, taking this goal off paper and making something happen, turning it into a reality, right? And strategic planning and operational planning are two different types of planning. Strategic planning is what we call long-term, and it's going to involve 5 to 10 years. Operational planning is your day-to-day operations. It's short-term. You know, we can't look beyond today. It's what can we do in the here and now? What can we control, plan for, schedule, budget for, and prepare for? Directing is one of the functions of management. Directing would be maybe keeping your workers on task and making sure they stay focused, or motivating them to complete the task at hand, right? It may be keeping production flowing even though there may be a bottleneck in the production line, or maybe someone became ill and they can't go to work that day, so they have to perhaps lead them without that person and kind of direct them and motivate them to, you know, keep on going, stay on task, you're going to get through it. Very important role. Now, when it comes to controlling is all about keeping things in order. When we are able to look at results and compare them with expected, we're controlling. We're trying to keep everything at bay, everything working, moving. We do use feedback as an input to our controlling, because with the feedback, we're able to make those kinds of decisions, isolate problems. It makes a note here in the bullets that it talks about management by exception. And so when we look at actual results and we compare them to expectations or maybe our budgeted results, it's called management by exception. Or you may also consider it like variance reporting. Management by exception would be where we're working hard, we're working on the line. Let's say we produced I don't know, 600 widgets, okay, but the goal was to produce 700 widgets. So obviously we didn't meet the goal. Why? So it would be flagged on a report as an exception, and we would need to go and start figuring out, okay, well, what caused this? Why did we not meet our expectations? What is the trigger? What is the problem? And so we do reporting by exception only. If the goal had been met, we wouldn't be concerned. We wouldn't be worried about it. Improving. Continuous process improvement. I grew up when TQM was a big deal, total quality management. But even with that, continuous improvement was always the goal. And basically, it means that you can continuously work to improve. It's a constant cycle in which we have this, we improve it, what can we do to make it even better? Don't ever be satisfied with the current. You need to find a way to make it better. There's always a better way. There's always a more efficient way. There's always something that can be fine-tuned. And it's constantly improving that process or improving the product. And thinking outside the box, I think, also is part of that process when we're doing the continuous improvement. What about decision making, which it's not always easy to do, right? Decision making it's easy to make the decision, but you have to, I mean, it's easy to make a yes or no decision. It's easy to make, if you have to select a project A or project B, it's easy to select the project, but we have to also live with the results of making that decision. You know, for every decision, there might be a consequence too. And so that is so important that when we are making a decision, we're making the right one based on the information that we have. So that's one of the reasons why management accounting is so important, is because we need to provide accurate information. We need to provide valuable information that the managers can rely on so that they can make the best decision. We don't want to provide faulty information, because then we would be giving them inaccurate data, and then they may make the wrong decision, or we may have to deal with some consequences that would hurt the organization as a whole. Now, what are some of the different uses of managerial accounting information? Well, there are very many uses. I mean, I just think about the applications of such information. Not only can you use it for just cost information, but also quality information, I think. So it lists a couple here. We see here, like the first one, the cost of manufacturing a product can be used to determine selling price. Selling price is, you have to know the cost of the product first before you can establish the selling price, right? So once we know the cost, you may do a cost plus markup for your selling price. You may, whatever strategy you use, you need to have that cost information. Number 2 talks about comparing the cost of manufacturing these products over time and how it can be used to monitor and control them. I do think it's important to evaluate the cost of manufacturing products. One of the things that we don't really think about is when we're doing manufacturing or we're in that field, is your suppliers are of the utmost importance. Without reliable suppliers, or suppliers that provide quality product or materials, you can't fulfill the rest of that value chain, if we want to use some of the concepts we're discussing this week. So supplier relationships are very important. Performance reports can be used to identify, like we mentioned earlier, scrap. So performance reporting should be done every day, in my opinion. You need to make sure that you're on track with productivity, efficiency on the line, labor efficiency, how productive are we being. If we're not, I mean, usually you'll have like a certain percentage that you're at, like 80% productivity rate or whatever that may be. And you need to make sure that you're staying at that rate. And if not, perhaps on that exception report, it'll flag it, and you'll need to start determining, okay, what's going on? Let's start troubleshooting. Number 4, a report could be used to analyze efficiencies and savings of purchasing maybe a new computerized equipment. I mean, in order to make that decision to purchase equipment, we would need to look at our options. We would need to look at what we have currently in place, what else is out there, what's the cost, what's the speed, what are our competitors using, you know, anything that we can bring together and kind of establish and compare will help us in that decision making. And then it also mentions here a report could be used to analyze how many report units need to be sold to cover operating costs. Okay, well that is true, right? We can be, when we talk about break even, I believe later in the class, it talks about you know, how many units you have to produce to or sell to break even, or how many sales dollars you need to make to break even. That is part of managerial accounting. because it helps us not only establish where we're at now, but also targets. So target income for the month, target units to sell for the month. It's very helpful in terms of planning and forecasting. Hopefully that was clear. Manufacturing operations is another factor we need to look at. The operations of a business can be classified in service, retail, or manufacturing. And it talks about how what we're learning now can also apply to service and merchandising. It's not just manufacturing. We sometimes assume that management accounting is just manufacturing, but it talks, and it looks here, it says, there's an example on the next slide. Well, it's supposed to have an example of a guitar, but a guitar manufacturer, not only would we need to be concerned about the production of the guitar, but also we would need to be evaluating factors of, you know, are we going to be having warranties for that? You know, what other services come into play? What about direct and indirect costs? So there are so many ways to categorize costs, right? There's direct, there's indirect, and we'll see later that there's period, there's product. The easiest way, I think, well, first let's talk about the cost. The cost, we know, is kind of like it's an expense, but it's not, because the cost is a sacrifice made to obtain some benefit. So we need to consider what the cost is and determine if it's worth that cost in the end. We know from experience and readings that costs are sometimes tied to a cost object, and that cost object could be a product, it could be a department, an activity, depending on the industry, of course, that will dictate what the cost object is. Normally, its cost object would be the product, but that can change if you're in a service organization. Okay, so direct and indirect. When I talk about a direct cost, I'm going to use my sunglass example again, because Ray-Ban, I mean, we all know what the product is, right? It's a sunglass. So anything directly on that sunglass is a direct cost. So frames, nose pads, lenses, any of that would be part of the direct cost. Same thing goes with an automobile. If you have a car, tires, wheel, I mean, they have a lot more in a car, right? But those direct costs are on the product. So it says here, for example, the cost of wood used to make guitars is a direct cost. Now, an indirect cost would be only identified if it's traced to a cost object. So indirect costs, we cannot directly associate it with the product. So maybe you're looking at the depreciation on machinery and equipment. So it's part of the process, but we can't directly allocate it to the products. It also talks in this example about salaries of production supervisors of producing the guitar. So it is still associated with the product because it's production supervisor, but it's indirect because we can't apply salary, you know, X amount to each guitar made. It would be too difficult at that level to do that. And so we come up with allocation methods to find ways to appropriately allocate the indirect cost to the cost object. Now, here on this slide, we're looking at the costs of a manufactured product. Remember that when we're looking at cost, it's not just the material. We also have to consider labor and overhead. Because I mean, I know a lot of things are automated now. So the automation portion would be overhead. So if it's a manufacturing plant that doesn't have people workers, it's using robots, those robots would be part of the overhead because it's still part of the manufacturing, but we would be considering them as the overhead associated with the production, and we would allocate that out. But direct materials, it's self-explanatory. The direct materials would be directly associated with the product. If we use the car example, maybe we're making, oh, I don't even know, a Ford truck, okay? The materials would be everything on that truck. Tires, wheels, bumper, seats, steering wheel, everything you can imagine. Direct labor would be the workers who worked on that vehicle, like put it together, assembly line and painting, the ones that have to spray paint the final product. And then overhead would be, I like to call it everything else, right? It's everything else that was associated with production of that product. So here it kind of goes into details about those direct material costs. This is an integral part of the finished product, like we've already had mentioned. And it really depends on what you're making to determine what the material cost is, but it's the raw material. So if you were looking at a balance sheet, it would be raw material inventory account. That would be the material. And it provides a couple of examples from our guitar example, the cost of wood. Maybe if you're making TVs, it's the cost of the components. Wafers or computer chips, and then tires for automobile. So those are just some examples that maybe you could relate to in terms of direct materials. Now, most manufacturing processes use employees to convert that raw material into a finished product because it's not going to happen itself, right? We need human intervention or some kind of intervention to make these parts become this product. So now to become part of direct labor costs, it must be an integral part of the finished product, and it has to be a significant portion of the total cost of the product. When we're looking at direct labor cost examples, think about the car example. That would include like the assembler's wages for assembling maybe the final product. We're looking at operating wages for manufacturing tools, wages for maybe repairing an automobile. All of those wages would be part of the direct labor cost. And now I know that when I worked in aviation, we had a very sophisticated system in which when they were working on an airplane, for example, when the worker would clock in to work that day, they would actually clock in and they could associate their hours that day with the project. And that project may be an aircraft that they're working on, or it may have been a subassembly. But we could actually trace their hours worked to a job order number or a work order number. And that in turn would help us cost the final product. So it was a very efficient system. Factory overhead costs, these are the costs that are everything else that don't fit in the other categories, right? And direct labor or direct materials. These are some examples here. Heating and lighting in the factory. And now they still have to be part of the setting or the making of the product, but they're kind of external to it, they're indirect to it. So it'd be taxes on the factory buildings. Notice how it has to say factory in it or part of that process. So warehouse, it'd be like insurance on the warehouse, depreciation on the warehouse, depreciation on factory equipment, It could be salaries of the personnel working in the manufacturing plant. It has to be somehow still part of the process, but indirect, all the same. Now, switching gears a little bit, there are other ways to, like I mentioned, to classify these costs. And prime and conversion are two such groupings, okay? Prime costs are your prime costs. When I say that, I mean like direct costs. So when you think prime, think of direct materials, direct labor. Conversion, on the other hand, is the process of converting. So it would be the labor and the overhead. So it's converting those materials into the finished product. Direct labor is both a prime and a conversion cost. Prime because it's the prime part of that product, but also it's conversion because it's involved in the converting of the product to the end product. Okay, I guess I should say the working process to the end product. Now, some of you had posted in the discussion about product and period costs, which was very helpful, I think. Costs can be broken down into product and period costs. The way I like to look at this is product costs are capitalized, they're on your balance sheet, they are assets. Product costs will be part of that inventory. It's going to be the direct materials, labor, and overhead. It's going to be sitting in an inventory account until that product is sold. Key word here is product and the fact that it's going to be in inventory and it's an asset. Period cost, on the other hand, is an expense, okay? And it occurs within a certain period. So it could be a selling or an admin expense. It's expensed out, it's on the income statement, and it has nothing to do with being on the balance sheet, okay? Selling expenses could be incurred from marketing, admin could be incurred by maybe someone who was doing the administrative portion of handling payroll, what have you. But these are significant that we can classify them this way because it helps us understand the manufacturing process easier. So in these two bullet points, it talks about how product costs, when they are incurred, they're reported on the balance sheet as inventory. When that product is sold, remember, if you go back to accounting, remember when inventory is sold, we would go ahead and debit cost of goods sold and credit finished goods inventory. So that cost of goods sold will eventually appear on the income statement, assuming it sells, right? Period costs are reported as expenses on the income statement, so they would never show up on the balance sheet. If you have questions on that, let me know. Try to think about examples, but basically anything that's part of the inventory cost would be product. Period is an expense, okay? This visual right here is very helpful because it talks about product and period cost and how the product costs do flow to the balance sheet first as they sit in inventory. And then once they eventually are sold, it becomes our cost of goods sold income statement. Period costs never go to the balance sheet. They go directly to the income statement. So that's a very helpful visual to understand the differences. Now, what about the financial statements for manufacturing? When we look at the statement of stockholders' equity and statement of cash flows for a manufacturing business, they're similar to those for both service and retail businesses. Balance sheet and income statement would be more complex because they're going to have different types of accounts. You're going to have a cost of goods sold. You're going to have maybe different types of revenue accounts, different types of inventory accounts. So it's going to change a lot if you're looking at manufacturing. So this highlights those different inventory accounts. With manufacturing, you have three types of inventory. You have materials inventory, work in process inventory, we call WIP, and also finished goods. Finished goods will be have the highest value because that's the finished product. That's what you're getting ready to sell, right? When you sell that, you would credit finished goods and debit the cost of goods sold. Materials inventory are those raw materials. We first buy them from the supplier. We stick them into the raw material account until we're ready to use them in production. Work in process consists of consists of direct materials, labor, and the overhead. This is like in a holding account. While we are making that product, those costs are sitting in work in process. They're not costs, so we're not expensing them, but they're in work in process or in WIP. And they're going to sit in that account until we can complete that job or we can complete that order or project or whatever it is. Once that product is completed, we would credit WIP and debit finished goods. The costs will flow through from materials, work in process to finished goods, and in that order. I will try to post some examples of cost flows so that you can see in different industries how those costs will flow out. Now, the income statement, like we mentioned earlier, they're going to focus more on the cost of goods sold. Now, a retail business determines cost of goods sold by adding purchases to beginning inventory. But manufacturing is different because we're making the product, we're not purchasing the product. So there's an added step that we have to consider when we're looking at manufacturing, okay? We have to compute basically cost of goods sold in order to get to that step. So it's something called a statement of cost of goods manufactured, and what that does is it summarizes all the cost of goods used to manufacture the item, and it's going to flow through and become part of our cost of goods sold. So the statement of cost of goods manufactured, you have to determine the cost of the materials used, the raw materials. Then we need to determine total manufacturing costs, and then that becomes our cost of goods manufactured. So there is a flow process. The flow starts here. We have our direct materials, labor, and overhead, the three primary costs that we'll see in manufacturing. Once these have been used and pulled from inventory, for example, they become part of this manufacturing process. If it's finished, it becomes finished goods sold or finished goods inventory. If it's unfinished, it becomes WIP. Any unused material stays in raw material inventory on the balance sheet. I really like this diagram because it shows you what statement they're on while they're in that period of time or when they're in that state of, whether being finished, unfinished, or unused. Eventually, this finished goods becomes cost of goods sold, and that will flow out into the income statement. But in the meantime, anything unfinished stays on the balance sheet, and anything not used stays on the balance sheet. Now, the last part of the presentation is on utilization rates. When you think about utilization, you kind of think about productivity, like how much do we utilize, how much do we use, how effective have we been? And you're looking for a higher rate. Low rates are not necessarily good, okay? And there's so many applications for utilization rates. You can use it in a hotel, for example, hospitals. I think those would be the best examples because you're looking at how much are these rooms used or how much are these beds being used in the hospital. So different industries will have different names and meanings for this metric. This is the actual way that you would go about determining a utilization rate. So the example presented here is a hotel. Occupancy rate would be determined by guest nights divided by available room nights. And then here we're discussing guest nights would be the number of guests times the number of nights per visit. And then available room nights would be the number of available rooms times the number of nights per period. the number of guests is determined under single room occupancy. So we have to establish some assumptions before we do the calculation. Let's assume that Easy Rest is a single hotel with 150 rooms. During the month of June, the hotel had during the month of June, the hotel had 3,600 guests, each staying for a single night. So how would we go about calculating the occupancy rate? Guest nights, we would take the 3,600 guests that they give us. Now, for determining available room nights, we take the 150 rooms times 30 days because we're just looking at the month of June, right? That gives us an occupancy rate of 80%. So they were pretty full. I would consider that to be a very favorable situation. It would be interesting to see how this trends. You know, is this because it's in June only? Is it because it's in the summer and maybe they are busier in the summer because they're near a tourist spot or near the beach, or, you know, maybe there's some underlying assumptions that we don't know. But it would be interesting to see, is that capacity or occupancy rate common every month, or is it just for that month? You know, be interesting to see how that would change perhaps. Maybe that's the threshold too. So maybe in the following month it was 75%. Well, why did it dip? What was the cause? And what can we do to bring it back up to 80% or even higher, right? So very useful. Let's go back to, that's all that I have for the slides. Okay, so I will go ahead and try to post some useful tools, especially in terms of the cost flows. I think I have some diagrams I could share with you. If you have any questions on anything that we've covered, please feel free to email me. We will have our normal live session in week 3. I've already put the hours or the session out there, the link and everything, so it'll be more hands-on. But I do appreciate you watching the recording, and I look forward to working with you during these next couple of weeks. And I hope that you have a great evening, and I look forward to working with you. So thank you very much.